Okay, Rajat Bhattacharya is joining us. He's Senior Investment Strategist at Standard Chartered. Rajat, good to have you with us here. Thank you very much. Will the market go into a bit of a sideways track for the rest of the year? Or do you expect aggressive moves from here? Because we got a glimpse of that last week out of the US. We got some rub-off here in India as well. But do you think this is it? Or will we continue to see aggressive action? What's your sense?
Hi, Prashant. Yes, I think that we are going to see a bit more pullback in the markets. And why? Because as you saw last week, the central banks in the US and Europe are both hawkish and more hawkish than the market. They have a reason, and why we say that, because the Fed is telling us very clearly that it wants to induce a recession. If you see their new forecast, what it's projecting is higher unemployment rates, lower growth. It puts growth for next year 0.5, but that's just by the by. If you watch the unemployment levels, that's going to go significantly higher. The projections that they've made suggest that you can only get that high level of unemployment through a recession. So they are trying to induce a recession to cool down the job market. And that, they believe, will cool down the wage pressures, which is their biggest risk. So given all that, and we've heard from Lagarde as well in Europe, where she was hawkish, and she was saying that the market pricing of the terminal rate for ECB is way too low. And we should take her on her word, because again, inflation in Europe, as we know, is still at 10%. That ECB has a singular target, that's a 2% inflation rate, and they're way off from there. I mean, their projections also, if you look through 2023, 2024, they're not going to get back to that 2% level in the next 1 or 2 years. So they need to keep charging on. Given that backdrop, we should see further pullback. We've been saying that for a while now. We have asked, we actually recommended investors to fade the rally going in November when it was peaking. S&P 500 is making that downtrend channel. It's pulled back from the top of that downtrend channel. Right. It's going to probably test the lower end of that channel.
Rajat, morning. Rima here. I think the last time we chatted, you indicated, which is close to about 3 weeks ago, that it was time to add your exposure to emerging markets, Asia ex-Japan. Could you tell us what is it that you've added to? Does India make it? What is the pecking order?
Yeah, that's a good point. So that's the other side of the story to the story I was painting about US and Europe. So we are bullish within that overall downtrend in global equities. We see we are underweight. We turned underweight on global equities. Within that, we are overweight on Asia ex-Japan. And now within Asia ex-Japan, we are overweight on China. Why we say that? Because China, as we've been highlighting for a while, is way undervalued. It's been beaten down. Its earnings expectations are looking up. If you see the credit stimulus there, it's picking up. We know the COVID story there, and they have been trying to ease that. Obviously, now we're facing the brunt of winter, and we're going to see COVID cases rise, and there's going to be some back and forth in terms of the recession, in terms of how this COVID easing goes through. But the direction is very clear. The direction is of an upturn in China. Given that we are positive on Chinese equities within Asia, India, we are more neutral because India, as we know, that the valuations are high. Now, that doesn't mean that we need to take money out of India. I mean, India is still, the structural story is very much intact. We know that the growth is going to outperform, India's growth is going to outperform the rest of the emerging markets, 7% growth, right? And if there is a recession in the West, oil prices are only going to probably soften from here. That's good news for India. So we're not going to take money off India, but the opportunity really within Asia is in China.
Hi Rajat, morning. So it appears structurally you continue to remain positive on India, though a tactical buy is on China in the near term owing to valuations and at current levels. Well, Rajat, I also wanted to ask you about the Fed. Now, they are talking about not cutting interest rates till 2024. Do you buy that? Or do you believe they will be forced to do it maybe towards the end of 2023?
Yeah, I think the second half we're going to probably see some rate cuts. So I do agree with the market on the second half, but not so much in the first half. I think the Fed means what it's saying in the first half. It's going to keep raising rates. In fact, we see a Fed terminal rate of as much as 5.25%. I mean, the market has pulled back. It used to be around 5%, right, the terminal rate, but now it has pulled back to around 4.8%. We see that as a temporary phase. It's going to go back towards that. Fed's going to keep charging along in the first quarter, especially, and then once the recession hits, we're expecting a recession somewhere in the middle of next year. So once the recession hits, job markets start slowing. Inflation will, of course, because of base effects, start slowing before then. It's already started to slow. All of that will come together to help the Fed to then soften back and pare back some of the rate hikes that they've made in the second half of next year.